presented stats in healthcare. Well, actually, introductions first. We'll just go down the road. A little bit of backdrop to M&A. Then just do a line of questioning. I think actually in the order we've got inventory review. Rather than sort of go around 2 or 3 times, we're going to just sort of run through it once, look at to watch, and open up to Q&A. And if not, it's a weird meeting. Just go ahead. Yep. Good morning. Can everybody hear me okay? Great. Well, welcome. This session is on the quest for value creation through M&A in the healthcare industry. I thought it might make sense first to start with introductions so you know who you're listening to. We also do want to make this interactive, so having experienced some of the other sessions where there was robust Q&A and always had to be cut off, we might actually cut down the formal remarks a little earlier to give people a chance to raise their hand and throw questions our way. But I'm Jim Priouz. I'm an MBA grad from almost 25 years ago, and I've been in the investment banking industry the entire time. And for many of those years, I was a healthcare investment banker focused on payers and the benefits management ecosystem, as we call it. And then headed up healthcare investment banking, so got to see and touch and build out other verticals within the healthcare industry, including life sciences, and I don't purport to be an expert at all in that area. And then my current role is at the head of the investment bank and the capital markets, running all the investment banking products. So now I'm a little bit more agnostic from an industry perspective. Unfortunately, it's made me slightly more rusty on the healthcare side, but no, just enough to be dangerous. So, Jim?
Thanks. My name's Jim Bridges. I've a 2-time UNC grad, so last year was the best basketball season ever, and I have a big poster of all the former Duke players crying in my office. But I've worked in healthcare for 25 years. I'm currently the senior vice president and general manager of what we call our government services businesses at a company called Change Healthcare, which until about a month ago was the largest independent healthcare technology company in the United States. We're now part of Optum, which is part of United Health Group, which is the 5th biggest company in the world. So just for frame of reference, healthcare has gotten pretty big and pretty concentrated. I've been part of probably over a dozen M&A transactions as an operator. So I have a little bit different perspective. I'm one of the people that runs the various businesses that get bought and or sold. So that's the perspective I'll have on the panel this morning. It's great to be here. Thanks.
Hi, I'm Jane Brown, and I love UNC Chapel Hill, especially as someone who has to pay for college for 3 daughters. Though I am from a different school down the street. I'll let you guess which one it is, where I got my business degree. I've worked for the last 15 years actually helping health plans and health systems innovate through mergers and acquisitions and investments as both an external consultant with PricewaterhouseCoopers and an internal advisor and strategic advisor, as well as an investment professional in a venture fund. So I'm here, I represent on this panel really how companies try to partner successfully or not so with large investment firms.
All right, first accomplishment, I got the mic to work. It's good. My name is Matt Mitcho, the CEO of Gemelli Biotech. It's can't call it a startup anymore. We're post-Series A funding and have a little bit of runway to scale our business at this point. Keenan Flagler graduate, '06. Does not feel that long ago, but I guess it is. Went to Indiana University in Bloomington, which we may or may not play UNC in the ACC Big Ten Challenge, and I will not tell you who I'm cheering for. So 10 years at GSK. After my time at GSK, went to a small, I would say medium-sized pharma company in North Raleigh called Salix Pharmaceuticals. I think where I fit into this conversation, Jim, is Salix was acquired in 2015 by a company called Valiant. It was quite interesting and tumultuous. I was there twice. After departing the second time, I worked with some folks at Cedars-Sinai in Los Angeles, licensed some technologies, and created this business that we're running now. So look forward to all of your questions and your discussion today.
Great, thank you. And I forgot to mention I'm with Truist Securities. I think it tells you what I did, but not where I do it. So I thought maybe it'd be helpful to give a little bit of context and backdrop to healthcare M&A. In recent years, there has been a proliferation of M&A activity instigated by both corporates, or what we call strategics in our parlance, as well as private equity, in particular private equity. If you look at the last 5 years, there was $470 billion worth of transaction in 2017, and that grew to $700 billion in 2021. So 50%, just 5 short years later, in the boom years of 19, even though 20 had a blip for obvious reasons in the first half, the second half took off again as the liquidity came back to the markets, and then we had boom years in M&A. And as an investment banker, we loved it. M&A fees to be had, financing fees to be had. We were quite busy until 2022 hit, and we'll get into that. The number of deals transacted went from 3,000 to roughly 4,100 a year in that sort of 5-year time span. Not that same 50% increase, which suggests that the average deal size in M&A naturally went up. If you look at 2017, the number of PE-led leveraged buyout transactions, which is a subset of M&A, was 11 that were $1 billion and over. By 2021, there were 30 over $1 billion transactions in healthcare just in that one year. So more transactions happening and larger transactions happening. Over that same time period, valuations also went up. So what PE or what corporates were willing to pay for a selling company went from roughly 10 times enterprise value to EBITDA, which is one of the ways we measure value in more mature cash flowing companies. EBITDA is a proxy for free cash flow. By the time 2021 rolled around and the markets were on fire, both the public markets as well as what we call the private markets, that multiple went up to about 12.5 times. So, pretty good, value accretion, if you will, which also enhanced the returns of those private equity firms who 3 to 5 years later, they hold an asset for 3 to 5 years, then they sell it. Well, they enjoyed EBITDA growth, presumably over that time, if they made the right investment. But they also saw multiple expansion, and so that drove, very strong IRRs. Speaking of IRRs, if you look at the 2 economic boom periods that the U.S. has had, 2000 to 2009, up until the financial crisis, PE-owned companies generated an IRR of 18% for healthcare. That compares to 16% for other industries. And then you look at the next boom period, which was sort of 2010 through 21, the returns were 27% for healthcare and 21% for all other industries. So a lot of shareholder equity value being created in the healthcare space. And as a result, PE was able to raise a ton of cash. They raised $1.2 trillion in cash in 2021 and had a war chest of $3.4 trillion, because that 1.2 was added to other cash that they had sitting in the coffers. And that cash is actually still there, interestingly enough. Unlike the financial crisis of 08, 09, when there was liquidity disappeared as a massive liquidity crunch, that actually doesn't exist. And that should actually help lessen the blow of a recession, should a recession come. Corporates have also got strong balance sheets that will also aid in that. So that's a little bit about sort of the backdrop that we are seeing. 2022, the times have changed. The S&P 500 at its worst was a few weeks ago was down 25%, so now down about 20%. So that's public market revaluing of overall industry in the United States. Healthcare is a little bit less. There are certain sectors of healthcare that are uncorrelated to the general economy. So there has been downward pressure on stock prices, but not quite to the same degree. Also the credit markets are not as constructive as they used to be. So the ability for corporates, but in particular private equity, to access high amounts of leverage to finance their equity and couple it with their equity infusions to drive these high values and purchase assets isn't there. The institutional credit markets have really pulled back. So, whereas a year ago, a bank like mine would be willing to underwrite to distribute, not hold, 7 times of debt to EBITDA multiple to help towards that 10 to 12 times purchase multiple, we're now in a market that's sort of 3.5 to 4 times. So you've had 3 turns of transaction value degradation because of the lack of credit availability, notwithstanding management teams concerned about what does the projection model outlook look like in an uncertain economic environment. So we talked a little bit about shareholder value, but importantly, what we hope to also address here, probably more importantly than that, is what sort of patient care value is this M&A generating? Is it leading to better care? Is it leading to easier delivery? Is it leading to less costly delivery and less costly, therefore, to the consumer, to the patient? So with that as the backdrop, Jim, I perhaps will turn to you first. You joined Change Healthcare and a premium healthcare technology business and lived through its acquisition process by UnitedHealthcare Optum. Through that. Tell us a little bit about that process, if you would, and then also, I know you weren't there the whole time, but what do associates think Blackstone did during its hold period to drive value there? The 2 types of value, the shareholder value, but also the patient value.
It's a great question. So I think that I want to get back to your previous question before I answer that one, which is, do we think we've seen the value of this show up in patient care, right? Which I think is the most important question for those of us that run the businesses that sort of lubricate, the healthcare economy and the care pathways for people. And the answer is I don't think so. And part of the reason is that we had things got so expensive in the last few years that it was very hard to make a strategic acquisition, which until recently was never the case. Strategics are ultimately one of your final exits unless you're going to go public, right? And why that is important is and why that was the case is if you disaggregated some of the conglomerates like we have. So Change had technology businesses in virtually every area of healthcare, and so we could compare ourselves. We could compare different of our business segments to a lot of the companies that were private, and if you had disaggregated us into our individual pieces and taken the name Change Healthcare off, the pieces would have been worth 7 times more than our company in the public markets. Just to give you a sense of how crazy the whole valuations got. So what it meant was, and by the way, that's about all the math I can do, so that's it. But what it really meant was when the real reason to buy things, besides to provide growth, which is I don't think the best reason to buy things, that's a whole nother discussion, is to add strategic capabilities that are hard for you to develop or will help provide a better, either horizontal or vertical, usually preferably a vertical integration in terms of your capabilities, i.e. I can do more stuff for the patient and make their outcome better and increase that value. And that got really hard to do for a few years if you were a larger publicly traded company. So I think when we were early, to answer your question, before the company went public and then eventually got bought, when we were early, the private equity backers, of which there was a few, provided, quite frankly, cheap money for us to do some of those acquisitions in that frothy environment. Later, to be fair, right, it also created a problem because they expected to have an exit, right, sort of regardless of where we were in our strategic journey along the development of some of those capabilities. So I would argue you have to be very aware of what you're getting into, and it's a mixed bag, right? Sometimes it's a benefit, sometimes it's an anchor, right, depending on what your objectives are and what's going on in the rest of the economy.
Great. And now that it's been absorbed by Optum, describe perhaps the Optum's strategic rationale, and are you a little bit more optimistic about the value that can be delivered at the end of the day?
Yeah, I mean, facetiously, Optum's part of United Health Group, and I think they're going to take over the U.S. healthcare economy. But so the strategic rationale was Change runs one of the biggest, what they call claims clearinghouses in the world. So 1 out of every 3 claims goes through Change Healthcare and gets processed through the network. And so having the ability to have additional insight, there's for those of you doing the analytics conversation, there's a lot of talk about the use of analytics. None of that works without data, without a lot of data, especially if you're going to train models and make changes to understanding and insight. And I think that was the broad rationale of the acquisition, and it's just happened, like literally a month ago, after 2 years, which we'll get into later with fighting with the Justice Department. But that was the overall rationale that they had in order to continue to acquire more information to service the healthcare broadly in a more efficient way. Great.
Jane, you have sat in an interesting intersection of the payer universe, and in particular Blue Cross Blue Shield for a number of years, that technically not for profit, but obviously very, very capable, and private equity partnerships, because successful entities like Blue Cross Blue Shield are looking for innovation, looking for ways to also invest its capital. And so they're partnered with private equity. Maybe you can talk a little bit about, from your experience, where that has worked well, what kinds of, what kind of culture at PE works well with the culture at a Blue Cross Blue Shield of North Carolina. Talk a little bit about the successes and maybe some places where it didn't work so well.
Yeah. Thanks, Jim. So I think when it comes to talking about when it went well, and it really comes down to what kind of partner you're in partnership with, is that there is a tension in the healthcare market between PE firms that are totally entrenched in a fee-for-service way of business that wants to continue to say, oh wait, you're underpriced products, I'm going to go in, I'm going to buy it, and I'm going to raise prices. And we all live with that all the time. And then there is a group of private equity funds that have a longer vision and understand that value-based care is really what's going to improve outcomes and really wants to make a difference there. And I think we had an opportunity to work with some of those firms on the venture side to get into things like Eleanor Health, where we actually started at City Block, different models that were really stretching to find ways to deliver care in to underserved populations, as well as in new areas like behavioral health. Prior to that, we had opportunity when we were working in an investment firm and we're just trying to learn about how to partner. I think we learned some hard knocks in that if you start with a growth proposition and with another firm and they provide the capital and they provide the strategic insights and they might even provide a Rolodex for who should be running that company, if the growth projections do not happen, then it can get extremely tense and your incentives start to divide very quickly. And so this happened. We actually had made an investment in a glucose monitoring company a number of years ago, and when they didn't have the growth that they expected, we got pushed off the cap table. And that's just going to happen because a private equity firm and an investor has two buttons to push when they invest in a company. Fire the CEO, put in more capital. And of course, if you're going to put in more capital, you're going to want more for that capital. And so, we were on the side of we want to make this innovation happen. We were more patient to see it happen. And I think that can become really tough when the decision-making cycle is, well, I'm going to wait for an 18-month insurance plan cycle to just see how things play out, to I'm an investor who wants to make sure that my capital is deployed well and I'm moving quickly. So saw multiple opportunities there where it started out great, but if the growth didn't happen, the interest diverged naturally.
You mentioned patient capital. For those private equity firms that were better actors than some of the other private equity firms you worked with, did you sense that their anticipated hold period was going to be longer than the classic 3 to 5 year model, and presumably just invested for a longer horizon and gave more rope to management?
Most definitely. I think but even more fundamentally, it's what their thesis was on how the market will create value. And I think when you look at somebody like General Catalyst, who invested in Eleanor, that was a previous speaker here, I mean, they fundamentally have a thesis that the market will be better and there is arbitrage in that market when it converts from fee to service to value-based care. And I think really diving into that and what that partner wants makes a big difference. Also just how committed they are to the area, like how many resources and how much are they built out to really serve the healthcare sector. I mean, if you have 3 acquisitions for healthcare and then you have in a portfolio of 50 companies, well, that's not a very deep bench. If you look at like Nordic Partners, they have doubled down and have done an incredible job of building out a very sophisticated thesis over time where they are looking for healthcare value and have experts who've done it. So that's really where you see the difference.
Yep, appreciate that. Matt, your experience currently dealing with perhaps earlier stage institutional money, but for a while your experience is more in the corporate to corporate M&A world. So working at Salix, at that time, Valiant was the ultimate consolidator of many spec pharma generic type assets, in the same way that Optum has become the ultimate consolidator and buyer of last resort for a lot of technology companies going through healthcare technology companies. Talk a little bit about just your experience, and I know you're there and then not there, then there. What went wrong at Valiant, and how was there not just shareholder destruction, value destruction, but also probably at the end of the day, it slowed the growth of a lot of these good products.
Thanks for the question and putting me on the spot. So two life lessons, right? So let your past experiences, influence your future decision making. So that's what we're doing at Gemelli is, we've learned some of these lessons from the past and are implementing new strategies. I think the second thing is if you don't have anything nice to say, don't say anything at all.
Is that the answer to the question?
It's a good way to, not get in trouble. I will say, so my specific experience there is when Salix was acquired, I left on day one. Having gone through the integration process, it was very clear that my ethics and upbringing did not align with the acquirer. That said, a mentor of mine from a previous life came on to run the Salix business unit, and she asked me to come back. And just like Marcus Saba, I can't say no to this woman. Hence why I'm here today. So I went back, and I think we were both aligned that it wasn't going well. She ended up leaving. I ended up leaving shortly after. Had some great opportunities to learn from some really good people that were there. Also some people that, you would choose not to work with in the future. So, yeah, I'll leave it there.
So I'll say it for Matt from a banker's perspective, and thank goodness I'm a banker and just that, as opposed to operators who do something real for a living. But Valiant was operating on a model of you purchase companies or really product lines that weren't being particularly focused on or marketed, and you buy them at a certain multiple. You jack prices up, put more attention to detailing to doctors and physicians to increase sales, and that drives the stock price up. At the end of the day, there was for a while, Valiant was a skyrocketing stock, so there was shareholder value creation, but there was no intrinsic value creation in terms of society and the consumer and whatnot. And eventually, that house of cards collapsed, and there were several other companies that engaged in that traditional spec pharma, and it was a tried and true business model at the time. Now, the market has redefined value there. So multiples that were 12 to 15 times for these companies, enterprise to EBITDA, again, going back to that, whether it's reflected in a private company multiple or their publicly traded price multiple, that's come down to about 4 to 5 times. We see through my business, I see some of these old business models still but they're worth 4 to 5 times. Banks are barely willing to put any debt leverage on them for obvious reasons. And so eventually the market caught up, but there's a lag and it takes a while, and there's some people that are fall victim to a loss of a lot of money.
Yeah, and I think the interesting thing is the product that I ran at Salix is called Xifaxan, which is for hepatic encephalopathy, which is a complication of cirrhosis, and has since gotten an indication for irritable bowel syndrome, diarrhea predominant, and it may do about $2 billion in revenue now. I mean, it's a real asset that helps real people. It was really the new approach to that I think kind of failed miserably. Just the debt that they took on, and kind of the macro business. So yeah, there's a lot of emotion there for me to kind of come back and right the ship, but it is what it is.
When we underwrite transactions, one of the things as we look at credit and do we want to take on the risk, and do we want to sell that risk to our institutional investors, is what is the percentage of R&D? What is the R&D as a percentage of revenues? The Valiants, it was 1-2%. Can't remember. I'm not a pharma person, but it's should be around 6 to 7% if you're an effective business model. And so you've seen a lot of companies adjust how they think about R&D and putting money back into their business as opposed to just taking money out for themselves, the shareholders. Last thing, Matt, now you're at a earlier stage, maybe beyond startup, but still early stage biotech entity. It's all about innovation, which is very different than the Valiant, which was not about innovation. Tell us a little bit about how that's going, and now how you view M&A as potentially helpful or not helpful to that.
All of the above. So I'll bore you with my personal journey here. There's a doctor at Cedars-Sinai, Dr. Mark Pimentel, that developed the use of Xifaxan, the previous product that I mentioned, for IBS. And he and I, along with a few other physicians, I am the only non-physician founder of the company, from Cedars-Sinai, developed this company in the summer of 2018, Gemelli. We licensed 2 assets from Cedars-Sinai. What really happens is a lot of larger companies don't want to take the risk of igniting a business or creating an asset. They want to see it at a certain scale, so then they can then bolt it on. You have to find somebody crazy enough like me that will say, yes, let's go build this thing out of nothing. So we had 2 licenses, a small lab in Irvine, California, and scientific intellect. And we've created 2 products out of it. Can't share revenue numbers or valuations or anything, but it's gone really well, which I'm super excited about. I would say the second part of it that you had asked was about M&A and kind of where we go from here. We still have a lot of value to create, but I'm not naive to think that the acquirer won't want to create even additional value on top. So it's finding the win-win, not to be cliche, where you get what you think you deserve out of it, but just don't be too greedy, because pigs get slaughtered, right? So
Yeah, and in the biotech world, selling yourself may not necessarily be the first step to monetizing a portion of the invested capital. Often it's if there's enough visibility, you go public first, have a couple rounds of issuing follow-on equity offerings until there's better line of sight, and then you have a large pharma company come in and hopefully buy it. And they're willing to, by the way, overpay, because the sweat, tears, and risk equity that has gone into the early stage has been de-risked for them, and they want to reward those people who took that risk. And so they don't think in terms of traditional comps. Well, this thing trolled this multiple of EBITDA. There is often no EBITDA, because these are still companies that are recirculating their cash back into growing and R&D. And so they'll pay some sort of a projected net present value of what ultimately the commercialized drug will look like. So that's the return at the end of the day that comes from
that's
that.
exactly right, and I won't go on and on. But the other thing I want to sort of draw back the initial experience to what we're doing now. Transparent pricing, our prices everywhere. We explain exactly how we bill insurance. We explain exactly what the patient will pay if they choose to use these assets. So that's the other thing. I think you can be very successful, which I hope we will be at some point, and do it the right way.
Right. I'll pause there. I said at the beginning we try to apportion a little more time to Q&A. So maybe we'll take a moment here and see if there's anything from the audience.
Any comments about the Inflation Reduction Act and the impact on companies? That impacts a pharma company, and maybe they're not looking for the money, or they can't charge what they want, so that might make it more purchasable. Is there discussion about how that's impacting healthcare and
The quick answer is it's very early. So we haven't seen, and the market hasn't yet, stock market and M&A. There's very little private company M&A going on right now. Just, I mentioned some stats. There was $700 billion of transaction value M&A in 2021. This year we're anticipating it's going to come in at about 400 million, down 45%, which is dramatic for us in the banking world. And most of the transactions that have occurred have been super large cap companies that are investment grade, that are not as affected by the credit markets, and their stocks have held up and whatnot. So there's no visible evidence yet that capping prices potentially on pharma is going to have a negative impact. I think some people, the concern may be, to the extent your pharma companies were reinvesting in R&D and whatnot, does this cause them to cut back on that sort of level of innovation? But the truth of the matter is, if you look over the last several decades, they have been cutting back on that sort of fundamental pure research anyway, because a whole ecosystem of venture capital and early stage biotechs have sprouted that acts as the laboratory, in the United States at least, for innovation. And that's how it gets financed. That's where the risk capital comes into play. And to your point, earlier, a large corporate is willing to come and overpay once they sense that something has matured, because they recognize a lot of blood, sweat, and tears have gone into the development. And if anybody else has a view on the Inflation Reduction Act.
Thanks for speaking with us. My question is, with increasing antitrust concerns, specifically within the healthcare industry, I'm curious as to what your thoughts are on the future with vertical integration, specifically within the healthcare systems pillar, I guess, with payers and providers? Should there be more Kaisers in this world, or do you see, some of these really large companies like Amazon, Walmart taking over the healthcare industry in the future? Just what your thoughts are, as well as how, I guess, the DOJ plays into that.
Jim, you kind of live that. You want to?
Yeah, so it's very interesting, right? Because the DOJ, I think it's going to depend on who we elect, right? I mean, this is, I'm not a very political person, but there was very clear political ramifications to the choices the DOJ made in terms of the acquisition that we went through with United. And so, they decided to try to fight the acquisition and blocked it, and United and Change sued and eventually won, and then the deal closed immediately after. I think you raised two different questions. So I think the vertical integration argument, what's really interesting about that, by the way, is it's not just a healthcare thing. This vertical integration argument, DOJ is paying a lot of attention to across industries. And the day that our deal, the day we won in court, there was like 6 or 8 other deals that were backed up on the same premise that justice had blocked them. And then justice dropped all the cases, like all at once. They all went through. So I think this idea of the power of vertical integration, largely because of large technology companies and the span of control that they have in all these ways, where they essentially create their own vertical integration in a downward methodology, has sort of blown that whole concept up in terms of justice. And I don't think we've got enough case law or enough history to understand how that's actually going to work itself out. I can say this particular administration has just gotten a lot more gun shy in what they're going to try to block under that philosophy. The Amazon thing's a great conversation, right? So I've been a healthcare guy for like 20 years. Amazon has tried a lot of healthcare businesses, and if you haven't noticed, they're not in any of them anymore. Because I think the general economics and third-party reimbursement system, combined with the chokehold that HIPAA has on data exchange and use cases, makes it really hard for those companies' thesis to expand in healthcare the way it's currently constructed. Nothing's impossible. The industry is generally terribly and inefficiently run, right? And so investors and other companies see that opportunity and think, well, I can apply these same principles from, name your industry. It doesn't tend to be very successful because they don't understand some of the limitations that are imposed, both regulatory-wise and data rights-wise. So that's my only caveat. And if you look, it's great because it pushes it will push regulatory changes, I think, ultimately in the long run, these kinds of things. But let's just say I wouldn't be putting all my money in the Amazon One Medical thesis if it was my cash right now.
I'd love to say more about it too, because there is here in North Carolina, it's the corporate practice of medicine. So you have to have separate entities between, somebody who practices medicine and who owns you. And so I can't wait to see what One Medical actually does. I'm optimistic that it's going to do a lot more for the patient front end, which is horrific. And so I'm optimistic there, but whether they're going to be able to drive margins from a very traditionally low margin business that's local versus can be consolidated, I hope they can. It'll be a fun show to watch.
Similar but different situation. Our sales professionals and our marketing goes towards gastroenterologists mostly. So when you had mentioned Kaiser, I thought that was very interesting. Right now, we're kind of in this stage of hand-to-hand combat. Sales professional calls on doctor makes a decision whether or not to use our diagnostic products. We're getting to a place where these large private equity roll-ups of gastroenterology practices are kind of like big chunks of land for us, and what's the pricing ramification of volume? So those are considerations that we are making at this particular moment.
One more comment I want to make, and I bet no one knows the answer. Who's the largest employer of outpatient physicians, primary care physicians in the country? It's United Health Group, right? So, there's all kinds of integration going on in all kinds of places, but that's an area where you can get around a whole bunch of these rules and a bunch of these these laws and regulations about data sharing because you're the payer and the provider. And that's where I think you're seeing a lot more innovation happen because of that, or at least you probably will in the future. But just be careful, like your doctor may belong to your insurance company when next time you go.
Yep. Healthcare partners transaction advice. Other questions, thoughts? Channel conflict question.
I would. It's an interesting question, right? The claims clearinghouse business is not worth what it used to be, right? Like it's if you look at the price of what you paid to exchange a claim, like back when Jeff Arnold, who I think spoke here last year, 2 years ago, when he started what's now Change, they were able to charge like $25 a claim, and now we charge like 6 cents, right? Like so, but the value of the data is sort of persistent, and the way the whole thing is architected, it's a hand-to-hand combat thing now. Like there's a handful of clearinghouses that have all the share, and they basically fight back and forth, you know, and with small exchanges of the share. That being said, I think on the payer side, we're already seeing implications of the deal in terms of who our customers are for our payer businesses.
I can add on to that. So when I was at Blue Cross, as soon as the deal got announced, I ran an analysis of what it meant for us to have that combination, because you're in, as you said, every sector, right? So both Change and Optum are really big players in our ecosystem, and I think it could spur on some more innovation, because we don't want to just have one vendor to do something that's so important.
When we're selling companies, Optum, as I mentioned earlier, is always on the buy list of folks to call to look at our asset. What's fascinating about Optum is they're one of the few managed care companies and payers that, well, being part of United Healthcare, who is the payer, that have managed to sell through the concern that a lot of folks have around channel conflict. It's actually remarkable. A decade ago, it was a lot. There was concern that will Optum share company its client secrets as a vendor to its parent. And they managed to, unlike most others, they managed to kind of sell through that. I don't know, maybe why is Blue Cross Blue Shield, North Carolina, why did they get comfortable with, using Optum's services?
I mean, it is crazy, because the Blues system loves to hate Optum, but then, or United, and they compete with them for insurance members, but they use their services, and some of it is because they buy everything and they deliver at the right price point. I mean, 6 cents a claim, that really makes a difference. And that when you're doing payment integrity, they've selected a few things as well that they've gotten really good at it. And I think payment integrity is absolutely one of them.
Right. Other questions? All right. Oh, sorry. Oh, there you go.
So, 2008 medical civil rights legislation, Mental Health Parity and Addiction Equity Act. 5 years ago, marked the compliance deadline. We're still having problems with payers complying with parity, recovering behavioral health disorders at the same levels without obstacles that they would be medical and surgical. When do you see that improving?
Jane, you're the payer expert here.
I am on, the seat is getting hotter as I sit on it. And so, but I'm independent at the moment, so it's great. So yes. I mean, I think the reality of it is that there is lots of really important things going on in parity, and it's not just about price. It's actually it's a web. It's like we could take a seat out of this auditorium and just carry it out. If it's tied to every other seat. To take it out takes time. And so I really do think with collaborative care models and with understanding of the fact that when you have a mental health problem, you're absolutely going to cost almost 2x what what the same person with that physical problem has. I think that's really where the hope is, as far as where the industry needs to go. Because just paying more isn't going to mean that more people are getting access to it. We actually need a new model that's really going to address the issue where it needs to happen.
I think I would argue as well, if you look at the data, that we already have a certain level of parity. The problem is people don't like what they have parity with, which is generally other places where you talk to people instead of cut them open, which is like primary care, pediatrics, right? And if you look what's happened at reimbursement for those over the last decade in fee-for-service, it's not an unfamiliar problem, right? And that's not a defense, but I'm like, that's the data that most of the insurers will point to.
If you could go back to 2008 and make recommendations to Patrick Kennedy, what kind of teeth would you give this legislation where we wouldn't be in the position we are now? I'm sorry.
So I think the move to value-based care is important, and that's what this whole conference is about, right? I think the problem is the incentives are still not aligned, which is why you see it moving so slowly, right? And early experiments that were sponsored by the government, like in Medicare, they didn't work. So I mean that definitely set back, in terms of showing the demonstrable savings around some of the early ACO structures. It definitely set that back in the industry. Right, and so that's the challenge. More teeth around that and better early reimbursement to allow people to endure losses would have probably gone a long way to making people push the models.
To follow that question, I think that where we are evaluating here, what do you see in the future, 5, 10 years from now? Hypothetically.
So I just want to make sure I get your question right. You're saying how quickly will value-based care be adopted?
Well, the problem with value-based care is we still don't have providers that are taking downside risk, right? We all can admit that. So how do you think we can get over that hump? But what do you see beyond that from a crystal ball perspective?
I think when CMMI a couple years ago was running very aggressive pilots where it was trying to push the envelope, I think we saw a lot of progress. And I really do think that the government's going to have to lead here. I mean, if they don't, there's no incentive for an equity firm who just made a big investment in healthcare to say, I wonder how I can make less money now. That's not going to happen. And and there is those occasions where they can find opportunities where it's a win-win, where someone has a better GI outcome and it's worth an extra dollar for this diagnostic, and it works, like what Matt's doing. But those are small and far between, especially when you are trying to talk about an entire system that's almost $4 trillion. So your vote matters is kind of what I would say on that.
Anybody else? Great, we're right at time, so thank you very much. Appreciate it, guys.
We'll have lunch starting back in the foyer area, and we got like a 30-minute break before our meal starts.
It was great.
Wonderful. Thank you so much.
You guys. Yeah. You too. I've got to exit the
No,
airport.
thank you so much. It was so good to, thank you so much for doing this. It was a great conversation. Yeah, no, thank you for being here. It was great. We had a good attendance. We had almost 100 people.